Hey there, it's David at Cross Country Mortgage. Today I want to talk about a loan option or solution that's come back into vogue recently, and that's what's called an adjustable rate mortgage or an ARM. So when people tend to think of a mortgage, they usually think of a 30-year fixed as kind of the default, and it truly is. That is what is the most common loan term or loan program someone takes out. But there is another option, and that could be in your benefit, and we'll go over kind of pros and cons here in a moment, and that is what's called an ARM or adjustable rate mortgage. So kind of a scary term, right? Adjustable rate. I don't want my rate to change on me. But let's talk about how an ARM works. So you may have heard of an ARM before expressed as a number, and that's going to be 3-1, 5-1, 7-1, so on. What do those numbers mean? That first number is how many years your interest rate is going to be fixed for initially. So on that 5-1 ARM, your initial interest rate is going to be fixed, will not change, will not adjust for that 5 years after you take out that loan. That second number is how often your rate could adjust. And so it used to be, the norm was a couple of years ago and before that was every year, so hence the 1. More commonly in the last few years, most loan programs now have switched to a 6-month time frame. And so now you're going to hear 5, 6, 10, 6, all the way up to 15-6. There are 15-year ARMs out there. Now you might ask, what about if rates go crazy? How is the rate computed, or where does that come from once you enter that adjustment time frame? And those are great questions and something that can kind of scary to any borrowers. So first off, how is the rate figured out if you do go into that adjustment time frame? And there's two components to that. There's going to be an index and there's going to be a margin. So what does that mean? The index is going to be what the variable part is. And most commonly right now, the index that ARMs follow is called SOFR, or the Secure Overnight Financing Rate. And then, like I said, there's going to be that second component, which is the margin over that index. So hypotheticals here. And I should say that margin does not change for the life of the loan. You would know that up front, ask your loan officer how much it is based on the loan program you're looking at. But let's say the index is 1% when you are going to next adjust on your loan, and your margin is 3%. So you're just going to add those two numbers together, you get 4%. That means for your next adjustable rate time frame, your payment is based off of 4% interest rate. Now, again, might be kind of scary adjustments, right? For that reason, there are 3 different types of caps that protect the consumer from case rates were to skyrocket and from payment shock, from your payment jumping too much. So the first type of cap is going to be the initial adjustment cap. So you've now left that initial fixed rate time frame and you are now in your first adjustment. And for these hypotheticals, let's just say it's a 7-6 ARM. 7 years of the initial fixed time frame, 6 months adjustment time frame. The initial cap protects you from how much the rate can jump over what your initial fixed rate was for the 7 years. And that tends to vary based on the loan program, but it's usually between 2 and 5%. So let's say your initial fixed rate was 5%. The cap on this loan is also 5% for that initial adjustment. And rates have just gone crazy. The index is now that high. You could not pay more than 10% in that hypothetical situation. Second cap is how much your rate can change every adjustment period. So every 6 months, again, on this 7-6 hypothetical. Commonly, this is 1%, but again, can vary based on the loan program. So your rate could not increase more than 1% every 6 months. The third is a lifetime cap. That is the highest rate you could ever pay if, again, the index were to go crazy. Commonly, that tends to be 5%, and that means your rate cannot be more than 5% above your initial fixed interest rate. So again, let's say the initial rate was 5%. Rates have gone crazy. Your cap is 5%. So again, you would never pay more than 10% on that loan. So still kind of scary that knowing that your rate could change. So why would this be a good option for a borrower to consider? And really the reason is that initial interest rate historically tends to be lower than what you would pay on a 30-year fixed. And so you're going to be saving money, at least during that initial fixed time frame on the ARM, compared to if you did a 30-year fixed option. And there's really 2 situations where you may want to consider this if you happen to fall into them. And that is if you know you are not going to own the home longer than that initial fixed time frame. So again, let's say you know I need to move in 5 years. So I'm going to take out that 7-6 hypothetical ARM because it has a lower interest rate than a 30-year fix. So during that 5 years I live in this property, I'm going to be saving on interest. The second is if you feel comfortable knowing that you are going to refinance the loan within that initial fixed time frame. And you can refinance into another ARM if you wanted to. The risk you're taking here is who knows where rates will be. We don't have a crystal ball. Otherwise, of course, we'd all be very rich. And so we don't know if during that fixed time frame will rates drop and give you the opportunity to refinance. So there is some risk versus reward that you have to consider in that situation. And the final part to consider about an ARM, or that is commonly asked, is how long is the term of this ARM? All right, so it's a 7-year fixed time frame, adjusts every 6 months. How long is this loan? So all ARMs do tend to still be 30-year products. So that means you make the payments. If you were to never pay it off early or sell the home, you would make payments over 30 years, and that is how the payment is calculated. So if you have any questions, feel free to send me a DM, an email, or you can call or text me.